I don't think that all of our audience really understands the implications of being a qualified small business stock under the Federal Internal Revenue Code. Can you go a little bit into the details of that?
I can, and it's a little dense. I'll try to make it entertaining, but I think it's important. Even if this is boring, many of your listeners probably need to know this issue. In order to incentivize investment at the earliest stages in business, the riskiest part of building a new business, the government on the federal level has a variety of incentives. One of them is we'll just use you, Phil, as the example here. Should Phil invest in my new business at the earliest stage? We as a country, at least for now, have decided we want to incentivize that behavior. And so to do so, we say, okay, well, if I ever have an exit or another term for selling the business, Phil's first, it just recently changed to $15 million of a gain, is tax-free from his capital gains on the federal level. So that's a significant tax savings, and it increases the return on his investment, should we do well. In theory, people, again, just using you, Phil, as this example, if you're investing in my business, you probably invest in a few others. So that sort of incentive helps de-risk it. Because I just talked about, right, the venture funds, they look for 1 in their 10 to do well. That's kind of the math, roughly. Right. And so you need them to do well to make up for all the losses. And so that's one of the federal incentives.
And so that's $15 million for every individual company that you invest in. It's not just $15 million for you as a person.
That's a good, that's a good distinction you're bringing up. It's $15 million. If Phil, I should have picked some other person since I'm talking to you, but if Phil, the investor, invest in 10 companies, each one potentially has that, qualifies for that benefit.
Mm-hmm.